The moment a new investor sits across from me and says, I'm looking for a property with cap rates above X, well, that's usually my first red flag. Not because they're a bad investor, but because it tells me that someone fed them the wrong framework for our local market. You see, cap rates, well, that's a commercial real estate metric. They were designed for apartment complexes or office buildings, not your duplex, not your fourplex, and definitely not your single family house here in Bryan and College Station. In this video, I'm gonna show you exactly why and how cap rates can lead you to a bad deal on a small residential property. I'll let you know what two numbers actually matter and how I stress test any deal in about 60 seconds. And here's the truth. The math is a lot simpler than you think. My name is Greg Schwartz. I'm a local investor and real estate agent here in Bryan and College Station, Texas. I've been buying and managing rental properties for over 8 years, so let's jump into the real math behind small residential here in Aggieland. Let's start with what a cap rate actually is, because a lot of people throw around this term without truly understanding where it comes from or what it means. So cap rate stands for capitalization rate. It's a formula that was built for commercial real estate. Think about 5 units or more, apartment complexes, office parks, or retail centers. Properties that ultimately get valued like a business, not like a house. So here's the formula. You take the net operating income, also known as NOI, and you divide it by the cap rate. And of course, the cap rate is set by the market and the asset class, and that gives you a property's value. Now, here's what I really need you to understand about NOI. Net operating income does not include your mortgage payment. And here's the one that trips everyone up. It also does not include capital expenses. That's the HVAC system that's gonna cost you $8,000 to replace. It's not in the formula. That's the roof. It's not in the formula. That's replacing a water heater. Also not in the formula, but those are real expenses, guys. You pay for them. So NOI is not cash flow. Even if you're a cash buyer and you don't have a mortgage, you still have capital expenses. They don't just go away because you paid cash. So it's a really important distinction to understand the difference between cap rates, NOI, and ultimately cash flow. And then lastly, your return. Real quick, if you find this information useful or helpful, hit the subscribe button. I drop a new video or new videos every single week. It's all about investing. More specifically, investing in Bryan and College Station, Texas. So that's what you're into. This is the channel for you. Let's get back into it. So if cap rates make sense for commercial real estate, then why does everybody keep using them on these small residential properties? Well, in my opinion, it comes down to one of two different factors, two different things. Number one, they don't understand our local market. Bryan and College Station is a residentially driven market. What I mean by that is, I don't know about other markets, but here locally, you don't value a duplex or a fourplex based on cap rates or NOI. You value them based on comps, just like any other home that's sold. So the framework simply doesn't apply here. And number two, and this is the one I really want you to watch out for, a lot of people who throw around the term cap rate when they're talking about these fourplexes, duplexes, or single family houses, they're just trying to sound more sophisticated than they actually are. The biggest investors I know, investors with hundreds of units, don't use cap rates to explain the kind of asset they're looking to buy because they understand what's actually important. Two numbers I'm gonna share with you later in this video. The important thing here is don't try to sound overly sophisticated. Real estate's a pretty simple game. Now here's where it can really get you into trouble. In commercial real estate, you can force appreciation. If you raise rents, then the NOI goes up. And if the NOI goes up, the value goes up. That's the formula. It's real and it works. But here in Bryan and College Station, on a duplex or a fourplex, the comps drive the value, not your spreadsheet, not your NOI, not your cap rate. So think about that. If you were to buy a fourplex, renovate every single unit, raise the rents, and optimize every single expense, but the comparables in the local neighborhood only sport a valuation of $450,000, well, your building is worth $450,000. The market doesn't care about your cap rate calculation. The bank appraiser and the buyer will care about comps, period. End of story. Someone tells you to look at a great deal because of the cap rate, ask them what the comps are, because that's the real number that matters. All right, so cap rates are out, but the question is, what do we use instead? Well, it's only two things. That's it. Number one, does the property actually cash flow? And I'm not talking about some optimistic number with half of the expenses left out. I want to see positive cash flow every single month, including real expenses. Your mortgage payment, your property taxes, your insurance, property management expenses. Even if you self-manage right now, there are still expenses associated with that. Your maintenance expense, a capital expense reserve, meaning you need to set money aside every single month for things like the HVAC, the roof, the water heater, the appliances, all that stuff that's gonna need to be replaced eventually. And if that number, after all those expenses, is positive, well, then we're in business. If it's negative, something's gotta change. Maybe it's the offer price, maybe it's the down payment, or maybe it's just time to move on. Now, I wanna be honest with you, in this market, cash flow is not always massive, but it needs to be real. It needs to be accounted for, including every expense, and it needs to be at least break even. After cash flow, the other number I want you focused on is going to be your annualized return on investment, otherwise known as annualized ROI. Now, this number allows you to compare your investments in real estate to other asset classes like the S&P 500. Your return on investment on an annualized basis is driven by three different factors. The first one is cash flow, which we already talked about. Now, most investors will stop there. In that case, then you're looking at a cash on cash return. But in doing so, you miss out on two major wealth creators. The second one is going to be your principal paydown. Now, of course, if you have a mortgage, every single month you make your mortgage payment, or really your tenants make it for you. And that mortgage payment includes a portion of principal paydown, and that is a wealth grower for you as a landlord. And the third one, I think this one's the most important, particularly here in Bryan and College Station, where we have an economic driver of Texas A&M. The third one is appreciation. Now, you might say that appreciation is speculative. If you're that type of person who thinks that appreciation is speculative, let me know in the comments below, because I personally think it's a number we can count on. The reason for that is historically, since 1990, the average home price appreciation in Bryan and College Station, 4.8%. That is a very steady number with very few ups and downs. Even back in 2008, when everything went to shit, Bryan and College Station held that appreciation number. And then you take the total number of cash flow, principal paydown, and appreciation in a given year, you divide that by your initial investment, and there you have it, your annualized return on investment. Here's how I actually analyzed properties in Bryan and College Station, and I do it in less than 5 minutes. And never do I care about cap rates. I have to answer three questions. First off, I need to understand the comps. Is the offer price that we're making or the purchase price that we're going to be putting in on this property, is it above or below the comps? AKA, am I buying a good deal? Am I buying this with some equity? Then the second two numbers, again, we talked about them, are going to be cash flow and return on your investment on an annualized basis. And for these two numbers, I turned to a calculator that I built out and ultimately set up for free on my website. Go to schwartzrealtygroup.com. I'll have a link down in the description below. You go to that website, you click on my calculator, you put in all the pertinent information. It will tell you if this property cash flows, or in my case, I want it to at least break even, and it will give you an idea of what your annualized return on investment is. Actually, this calculator gives you IRR. Longer story there, but the point is, I can then use these two numbers to determine whether or not this is where I want to park my hard-earned money. Again, schwartzrealtygroup.com/tools/rental property calculator. Link in the description below. That's how you can decide if this is a good property for you. And if you want more information about a property, or you just want to go over a deal analysis with me, shoot me an email. Send me the words cash flow to info@schwartzrealtygroup.com. I will personally respond to that and we'll get the conversation started. And if you want to know more about analyzing rental properties here in Bryan and College Station, I recommend that you check out this video here.